Hi, Doug Andrew here. Are you ready to gain some further insights into how to communicate the dynamic advantages of IUL to your prospective clients? We are going to address the question that you will be asked many, many times. How can I access my IUL cash value totally tax-free? Now, in my books, you'll probably read a clever little way that I've explained this. There's the sad way, the dumb way, and there's the smart way. So let's talk about these three different ways that you can access money out of an indexed universal life insurance contract. To begin with, I want to explain to you the difference between LIFO and FIFO tax treatment, because this is critical to understand as we teach clients who do not understand taxation. Now, most investments, IRAs and 401ks, they're tax deferred, and then you pay tax when you take the money out. But when we are talking about just normal places to put money, most investments are taxed as earned, or if you put money into them and you start taking an income stream, they are taxed LIFO. LIFO means last in, first out. So let's use an example of an annuity, okay? Now, annuities are taxed LIFO. So what does that mean? It means that if you were to deposit, let's say, $500,000 into an annuity, and you immediately annuitized it, you started taking income. And to keep it simple, let's say you're earning 10%. Most annuities don't earn that much. Maybe some indexed annuities can, but let's just assume 10% because it's easy to calculate. So 10% on $500,000 is $50,000 a year. So if you do not want to deplete your principal of $500,000, you want to just live off of the interest, you could take out what? $50,000 a year. But since it's taxed LIFO, that means the last money you're earning, which is your interest each year, is the first money that's coming out, last in, first out. So that's LIFO tax treatment. You would be paying taxes every single year on your 1040 tax return on that $50,000. It's only when you dip into the principal, the $500,000, and start to deplete that you get sort of a little break because you already paid tax on the basis, the $500,000 you put in there. Now, life insurance is unique because in the Internal Revenue Code, it's one of the very few investments that are taxed FIFO, first in, first out. So what does that mean, FIFO tax treatment? Let's use the same example. If I put $500,000 into an insurance policy, and you know I can't put it in all at once without violating TAMRA, but let's just keep it simple right now. $500,000, and if it was earning 10%, which many of my clients were earning net back in 1980 to 1990, if you started taking out $50,000 a year and you just withdrew the money, it's tax-free the first 10 years. Now, why is that? It's because you're taking the first money that you put in, the $500,000, and you're recovering your basis. So I take out $50,000 a year times 10 years, and the first 10 years it's tax-free because I already paid tax on that. Now, the 11th year in that example, I would now trigger tax. I would have to start paying tax on the gain because the first money in was the first money out. Now I'm into my gain. That is the dumb way to pull out money. So stay with me here. I'm going to talk about the dumb way and the smart way, but let's cover the sad way. Now, if you haven't figured this out, the sad way is by dying. Now, I wouldn't recommend that one, but it's one heck of a return. So in other words, if I was a 60-year-old male and I wanted to maximum fund an indexed universal life policy and take the least amount of insurance the IRS would let me get away with under TEFRA and DEFRA guidelines, I can put in $500,000 as a GSP, guideline single premium, and the minimum amount of insurance required would be about $1,250,000. Now, if I put in the first $100,000 under TAMRA and I died that year, the insurance company is on the hook. They're obligated to pay $1,250,000 tax tax-free to my beneficiaries. See, that's one heck of a return if you calculate it, but it's the sad way to get it out. Now, I have stories in my book where I never dreamed my brother would pass away in an accident. We set up his IUL to be able to perform for his retirement, and he got killed in a car accident. I've had many people that all of a sudden they had some unfortunate set of circumstances. One gentleman who was an insurance agent was diagnosed with a terminal liver illness because of the physical exam that he got to take out his insurance policy. Now, he passed away within about 14 months. So when you put money into the insurance policy and you pass away, it blossoms in value and transfers income tax free under what section of the code? Section 101A, if you remember. That's been a sacred cow in the Internal Revenue Code for more than a century. So the sad way is by dying. It's one heck of a return, but I don't recommend that one. So let's go back to the dumb way and the smart way to access money out of an indexed universal life insurance policy. As I mentioned, you get FIFO tax treatment, and so if you call it a withdrawal, or some companies call it a partial surrender, then you're able to recover your basis first, and you don't have to pay tax. But thereafter, it would be dumb to keep withdrawing money because now you're triggering unnecessary tax. Do you know the IRS basically says, you don't need to do that. This isn't a loophole. They know what they're doing. They said, no, just change the nomenclature. Change what you're calling it when you're accessing money out of that insurance policy, and it will be tax-free. How do you do that? Well, what's the nomenclature? Instead of calling it a withdrawal, call it a loan. Now, when people first hear this, critics go, what? Borrow your own money? Why would you borrow your own money? Hey, that tells me right off the bat, they don't know what they don't know. They don't know how money really works. So when you borrow the equivalent of your interest out of your insurance policy, it is the smart way for several reasons. I didn't tell you that if you withdraw or partially surrender your insurance cash values, that actually reduces the amount that you could ever put back into the policy. My heavens, why would you want to do that? So most of the time, people will use the loan provision right off the bat. They don't care about FIFO tax treatment. They want to use the loan provision. Now, let me explain the simplest way to do a loan on your insurance policy. It is what we call a zero wash or zero cost loan. Now, if I were showing this on a ledger, the insurance company is going to give you this statement. And let's say you have $1 million of cash value, just to keep it simple. And you can extrapolate from this example whether you have 10,000 of cash value, of 100,000 or 10 million. But let's say you have $1 million of cash value and you need to access some money. Maybe you want to access just the equivalent of your interest. If you're earning a net rate of return of 10% like I have many, many years, that would be 100 grand. Maybe you want to access 900,000. You can usually access or borrow up to about 94% of your cash value. But what's interesting is if I borrow 90%, 900,000 out of my million, and I leave the last 100,000 in there, that's usually enough to cover the cost of insurance for quite a while and prevent the policy from lapsing. Because if the policy lapses, if you surrendered it and you put in 500,000 and it's grown to 1 million and it lapsed, or you surrendered it and you cancel the policy, you would be taxed on the gain. Why would you do that? Your gain would be 500 grand, right? You put in $500,000, it grows to 1 million. Your gain is $500,000, and if you're in a 30 or 40% tax bracket, you just paid $150,000 to $200,000 of unnecessary tax. I can borrow 900,000 and I get the whole 900,000 tax-free because loan proceeds are not deemed earned, passive, or portfolio income. Those are the only 3 types of income we pay income tax on in America. And so this is really the brainchild of the insurance industry, but also the IRS encourages you to avoid paying tax because it's going to actually help out the country to help you have tax-free income. by changing the nomenclature to a loan. So if I go in there and I say, I want to borrow the equivalent of the interest I'm earning. So on $1 million, let's say that's 100,000. I'm going to borrow the equivalent of the interest that I'm earning that year, 100,000. Or if I borrowed 900,000, that's tax-free, and the remaining amount keeps the policy in force and it avoids paying tax. Now, you need to understand that when you borrow, you have this loan balance. Now, I call it a phantom loan balance. In other words, the loan is not due and payable during your lifetime. Did you hear that? Let me repeat it. If you borrow on your insurance policy, the loan is not due and payable during your lifetime. You can pay it off or make payments against it if you want, and I will share in the next episode when you may want to do that. But see, the loan balance accrues. So let's be simple here. If I've got $1 million of cash value over here, and all of a sudden I want to borrow $100,000 a year for income, and I want it to be tax-free because the interest I'm earning is $100,000. So the million would grow to $1,100,000. Instead, I am borrowing the equivalent of my interest. So if I'm borrowing it, the money is still there. See, the insurance company is collateralizing the loan with this $1,100,000. So now I have $1,100,000 minus the $100,000 outstanding loan is a net of the million you would have had anyway had you pulled out the money the dumb way and paid tax. So I don't have to pay tax. So I borrow out $100,000, and the next year I borrow another $100,000, and this one is up to $1,200,000. The cash value growing minus the loan balance, which is also growing, this minus this equals the same amount had you pulled it out the dumb way and paid unnecessary tax. Now, what's the dynamics behind this? When you borrow, in order for the insurance company to qualify it as a true loan in the Internal Revenue Code, the insurance company must charge you a nominal, statutory interest rate. So that can be down in the 2 or 3% range. So I'll use one company where I own Index Universal Life. If I wanted to do a zero cost loan, and if I borrowed $100,000 a year, they're going to charge me 2%. Now they charge me 2% on that $100,000, and over here on the $100,000 of interest that I didn't withdraw, it collateralized that, they will automatically credit me the same interest rate. So I'm being credited 2% on this over here. I'm being charged 2% on the phantom loan balance. It's a wash. It doesn't cost me anything, but I've complied with the IRS rules that we have to call it a loan, because loan proceeds are not deemed earned passive or portfolio income. Now people, they go, well, wait a minute. The loan's just going to keep growing. Yeah, 100,000, 200, 300,000 plus 2% interest. But the interest over here you did not withdraw is growing at the same 2%, but the original million is growing at 8, 9, 10%, whatever the indexed rate is being credited in that year. So everything is just fine the way it was, but because we did it the smart way, we do not pay tax. Now, in the next episode, I'm going to talk about another alternative. This is where you can use an index loan or a participating loan and actually earn more than what they're charging you in interest. And this will blow you away. And it's what I do probably 80% of the time. This is what most of our clients choose, is an indexed or participating loan. So when we talk about borrowing money, the smart way is to simply change the nomenclature. Hey, I don't want to withdraw my money. I don't want to partially surrender it. I want to borrow out the equivalent of my interest. They charge you 2%. Some companies may charge you 3 or 4, but they credit you 4. That's called a zero wash or zero cost loan. And it's pretty incredible when you do the math, how you can have tax-free income for 20 or 30 years. And ultimately, when you die, this blossoms into the death benefit tax-free and pays off all the phantom loan balance. And the net left over is what you would have had anyway. And that will blossom into whatever death benefit it is. And it transfers to income tax-free. This is pretty incredible. But in the next episode, I'm going to share with you why. You want to use a loan from day one to grandfather yourself to be able to put money back into a grandfathered contract and reinvest tax-free in case the IRS changes the laws or Congress changes the laws. Most insurance agents do not understand what I'm going to teach you in the next episode.